If you're self-employed, you already know the frustration. Being turned down for a mortgage over and over because you don't make enough money. You work hard, your business is doing well, money is coming in, but when you sit down with a lender and they pull up your tax returns, suddenly you can't buy the home you want. Sound familiar? Here's the thing, your tax return is supposed to look that way. You're doing exactly what your accountant told you to do. Taking every legitimate write-off you can to reduce your taxable income. But conventional lenders, they have to use that number. They don't look at the full picture. That's where bank statement loans come in. And today, I'm going to walk you through exactly how they work, the pros, the cons, and how to know which one might be right for you. I'm Rebecca Foote of the Rebecca Foote Mortgage Team. My team and I have been helping finance homes for over 20 years, and a big part of what we do is work with self-employed borrowers, business owners, and high-income earners whose income doesn't fit neatly into that conventional loan box. Bank statement loans are one of my favorite tools for this situation, and they're one of the most misunderstood. So let's break it all down together. Let's start with, what is a bank statement loan? A bank statement loan is a type of non-QM or non-qualified mortgage, which simply means it doesn't fit the standard Fannie Mae and Freddie Mac guidelines that conventional loans are required to use. Instead of asking for your W-2s, pay stubs, and tax returns, the lender looks at your bank statements. They're looking for 12 to 24 months of deposits into your business checking account. Sometimes multiple accounts can be used for qualifying, depending on your situation. The idea is simple. Your bank statements show what is flowing through your business regardless of what your tax returns say after your deductions. Now, the lender doesn't just take your raw deposits total and say, that's your income. They apply what's called an expense factor. Basically, an estimate of your business overhead based on your industry. The most common expense factor is 50%, meaning they add up all your deposits and then they subtract 50% off the top for expenses. Every business type is different, so your loan officer should walk you through exactly how your expense factor is calculated. Now, let's talk about how the income is calculated. Let me give you a quick example so this really clicks. Say your business had $300,000 in deposits over the last 12 months. Divide that by 12 months and you get $25,000 a month on average. Now we apply the expense factor. If your business type carries a 50% expense factor, the lender uses the remaining 50% of the deposits as your income. So $25,000 times 50% gives you $12,500 a month for qualifying income. That $12,500 is what gets plugged into your debt-to-income ratio to determine how much of your housing payment you can afford. Compare that to a conventional loan where your taxable income after write-offs might only show $60,000 or $80,000 a year on paper, which works out to be about $5,000 to $6,600 a month. The difference in what you can qualify for can be significant. Now, it's important to note, if you own 100% of the business, you get credit for all the deposits, just like in our example. However, if you own less than 100% of the business, the lender splits the deposits based off of your percent ownership. So if you own 75% of the business, you can only use 75% of the monthly deposits. So we take that original $25,000 a month times 75% and you get $18,750. Then apply the expense factor to determine your qualifying income. Now, as promised, let's talk about the pros and cons on bank statement loans. We'll start off with what makes bank statements great. The pros. Pro number 1, the documentation is simpler for self-employed borrowers. No digging up 2 years of tax returns and explaining every schedule and deduction. You provide your bank statements and your business ownership documentation, and that's the core of it. If you have an LLC or a corporation, you'll need to show that you own the business and what percent you own. It's that straightforward. Pro number 2, you may qualify for significantly more home. If you have strong cash flow but aggressive write-offs, a bank statement loan can unlock a loan amount you couldn't get anywhere near to on a conventional loan. I've seen clients qualify for 2, even 3 times the amount on a bank statement loan versus what they would get with their tax returns on a conventional loan. That's life-changing for some families. Pro number 3, common sense underwriting. I love this about non-QM lending. A conventional underwriter has to check specific boxes. No exceptions, no nuance. With a bank statement loan, there's room to look at the full picture. Strong cash flow, solid business, good reserves. Those are things that can carry weight, even if your credit history has a blemish or two. Pro number 4, no PMI. This is a big one that a lot of people don't realize. On a conventional loan, if you put down less than 20%, you're paying private mortgage insurance every single month, sometimes $200, $300, or even more per month, depending on your loan size. Bank statement loans have a minimum down payment of just 10%. So even though you're not required to put down the full 20%, you still don't have PMI. Even though the rate is a little bit higher, you're not stacking PMI on top of it. If you're finding this video helpful, please give it a like and a subscribe. It helps me push this content out to other self-employed people who are looking for options just like this. Now that we covered the pros, I would be remiss if I didn't tell you about the cons. Let's be honest, because that's what I'm here for. Bank statement loans are not for everyone, and there are real trade-offs you need to understand. Con number 1, higher interest rates. Because the lender is taking on significantly more risk by not verifying your income the traditional way, the interest rate is higher. On average, you can expect a rate about 0.5% to a full 1% higher than a conventional loan. Now, for some borrowers, that's a worthwhile trade-off to get into the right home. And as a self-employed borrower, the additional interest you pay is often tax deductible, which takes some of the sting out of it. If you want to buy the rate down to something closer to a conventional rate, you can always pay discount points. On a $300,000 loan, 2 points would cost you $6,000. Whether that makes sense or not for you depends on how long you plan to keep that loan. Con number 2, larger down payment required. While conventional loans let you put down as little as 3% and FHA as little as 3.5%, bank statement loans typically require at least 10% down, and that's with strong credit scores. Some borrowers may need to put 20 or 25% down depending on their credit profile. That's money you need to have ready. Con number 3, credit score requirements. Most lenders want to see at least 680 credit score for a 10% down bank statement loan. I work with lenders who will go down to 620 in certain situations, but generally, the lower the credit score, the more the down payment is going to be and the higher the interest rate. Con number 4, reserves. On top of your down payment and closing costs, lenders typically require you to show 3 to 12 months of reserves, meaning liquid assets equal to 3 to 12 months of your total housing payment. So if your payment is $2,500 a month and they want 12 months of reserves, you need to show $30,000 sitting in a bank account after closing. That can be in your checking, your savings, or a retirement account. Though retirement accounts are usually only credited at 70%, so make sure you factor that in. The good news, the amount of reserves is determined by your credit profile, so most borrowers only need 3 months reserves. Con number 5, not every lender offers bank statement loans. Your local bank or credit union probably doesn't have this product. Most bank statement loan lenders work through independent mortgage bankers or brokers, which is exactly why working with someone like us is so valuable. We can shop multiple non-QM lenders to find the best combination of rate and terms for your specific situation. How do you know which type is best for you? Here's my advice. Before you decide, compare both options side by side. When a self-employed client comes to me, I do 2 calculations. First, I look at their taxes and figure out what the maximum loan amount is they could qualify for on a conventional loan. Then I calculate their bank statement income and show them what they would qualify for that way. Sometimes the conventional loan route still works just fine and it saves them money. Other times, and this happens a lot, the bank statement loans opens up significantly more purchasing power, and even with a higher interest rate is the right move. Every scenario is different. Your income structure, your down payment, your credit score, your reserves, your goals, all of that plays into the path that makes the most sense. The bottom line, if you're self-employed and you've been told you don't qualify, or you've been told you qualify for far less than you expected, please don't stop there. There may be a better path for you. We do this every day. We specialize in loans for self-employed, business owners, and anyone whose income doesn't fit neatly into that conventional mold. We're licensed in multiple states and adding more states all the time. If you want to find out what you actually qualify for, all I need to get started is 12 months of your most recent business bank statements. We can typically have your qualifying income calculated within 1 business day. From there, we walk you through your options and let you make the decision of what's right for your family. Click the link below this video to schedule a free consultation. There's no obligation and no pressure. I genuinely love helping people figure this out. And if this video was helpful, please give it a like and a subscribe. I put out new videos every week on non-QM loans, self-employed mortgage strategies, and everything in between. I'm Rebecca Foote, and I'll see you in the next one.